Hey everybody, welcome back. So today I'm going to be talking about the wheel strategy. Okay, so the wheel strategy is just a really great way to make income on your portfolio. And I'm going to be showing you 3 stocks that I am personally doing the wheel strategy on. And later on, I will give you a quick look into that. Okay, so the wheel strategy, if you guys don't know, and I'm going to go ahead and use one of the stocks that I've been wanting to wheel at using stock ticker X. Okay, so steel, okay, United States Steel. If you guys don't know, the X stock has been just really down quite a bit in the last month, down 13%. I do think the entire industry as a whole with steel has been down. Just a lot of things going on over in China that has really affected this. But I do think steel is going to have a pretty good big comeback. Right now, the Steel Corporation is sitting at a PE ratio of 7.27. So I do think it's a great time to buy. But instead of buying 100 stocks, okay, so let's say I am interested in buying 100 stocks of steel, but instead of buying that, what I can do is I can go into trading options, and I'm going to sell a put, okay, expiring, let's say, about a month out. Okay, so in other words, if I sell a put, okay, so this obligates me to buy the share if it goes down to the whatever strike price I select. So, for example, if tomorrow I open up this put for $21, okay, so if Steel X Corporation goes down $21, I'll be forced to buy 100 shares at $21. But why is that great for me? Well, number one, I get a discount on the stock, right? I don't have to pay $22.11 right today to buy 100 shares of stock. Instead, I get to buy the stock at $21. And on top of that, I actually get paid a premium of 93 cents per share, or $93. Okay, so and if the stock never goes down to $21, if it just keeps going up to maybe $23, then I simply keep the entire premium. Okay, so to me, it's a win-win situation, especially if you're looking to buy a stock anyways. You know, if I'm looking to buy steel and I'm just waiting for either a good time or whatnot, I think it's a great way to just get exposure into it while making income using the premium, and then getting your 100 shares at a discounted rate. Okay, so now how the wheel strategy works is it always starts out with selling the put, right? And if you do get assigned 100 shares, right, the way it wheels is you would actually turn around and sell a call. So let's say I get assigned 100 shares at $21. Okay, so now I have 100 shares of steel, but instead of just waiting for a stock to go up, I'm actually going to sell a call. Okay, so, and whenever you sell a call, you want to go out of the money. So meaning that the stock has to rise to certain points before you are forced to sell your 100 shares. Now, why is that a good thing? Okay, so let's say, you turn around, you start selling calls, and this is called the covered call strategy. Okay, it's covered because you have to have 100 shares or a leap contract that covers you in case your shares get called away. So let's say you have 100 shares of steel and you want to sell a call option at $25. Okay, so if the price of X steel goes up to $25, you're going to be called away the stock, right? But why is that a good thing? Well, number one, again, you get paid a premium of $55 on that contract, and the stock, would have risen already. So by the time the stock gets $25, you would have made $3 per share, or about $300 on that trade, right? So either way, it's a win-win because your stock is up, you gain $300, and you get paid a premium on top of that. All right, so if you can imagine doing that over and over again on just various stocks, your portfolio can grow really, really quickly. Okay, so I want to talk about 2 other stocks that I'm doing this with. So the first one is steel. The second stock ticker is Sofi. Okay, so Sofi Stock. If you guys don't know, Sofi just is a really growing, popular fintech company. Right now, the stock is trading at $19.38. I actually got in around like $17, and so it's a new company. So as you can see, that it's relatively new. It just started really just this December of 2020. Now, just there's so much talk about SoFi. I do think it's going to be a great stock to purchase, especially because there's so much potential in the pipeline. So let's take a look at some options we have for SoFi. And right now, if you're selling puts for SoFi expiring in November 19th, you're going to get deals where, okay, look at this, right? If you sell a put, if you're willing to buy the stock at a discount of $17.50, close to what the price I purchased for, you're going to get paid a premium of $75, right? So in other words, if the stock goes down to $17.50, yes, you'll be assigned the stock, and you'll also get paid a premium. So not only are you getting a discount of the stock today, you're also getting a premium of $75. Okay, so that's kind of what it looks like if you turn around and sell the call. Let's take a look at that. So you got some options of $22.50, or if you're a little more risky, you can do it at $20. But I would probably go, at least $22.50 or $25, because I do think the stock is going to go up. Okay. One last company I'm gonna be talking about today, just for the wheel strategy, and these are just stocks that have pretty good premiums for on the downside if you're selling puts, and then still decent premiums if you're going on the upside where you're selling covered calls. Okay, so the stock ticker is SBLK, and I know I've talked about this probably a little too much. Love this company because it is in the shipping industry, and right now, as we all know, there's a ton of just delays with the whole shipping business. But I think it's a great time to buy because there is such a high demand for shipping. Okay, now this stock does pay a really high dividend, so if you do get assigned, great. We're gonna take a look. SBLK. So right now, if you're selling puts expiring in November 19th, you can get premiums of $100, $70. These are all really great premiums to collect on a discount. So if the stock goes down $21 or $20, you'll get assigned those stocks at those prices, but you also get paid a premium. Okay, and then if you look at the upside, where you sell a call, again, great premiums, right? $25, $26, even $27. You're still getting paid $35 to sell it at $27. Okay, so that's really how the strategy works. You want to keep it pretty simple. You're just selling puts, selling covered calls. Yeah, make sure you just like and subscribe if you like this content, and I will see you guys next time.